also in a place where the put, the sort of Fed put is previously was all news was good news. If it was weak, we were going to get liquidity. If it was strong, we were going to get liquidity. And it feels like now that those players are backed into certain corners, both somewhat politically as well as fiscally, as well as monetarily, where now it's starting to be like it's all bad news. The economy's really strong. Oh, we're going to taper more. We need to raise rates more. So you'll get news that typically may have been good news in previous types of cycles, which is now potentially has some other implications to be sort of negative news. Yeah. And so you can get this cycle where the news is just, it doesn't matter what it is. It's all kind of temperate and creating that volatility you're talking about.
Yeah.
I would add just the news today, in our opinion, certainly added to a lot of that volatility. If you look at the jobs report, obviously the headline number was a pretty soft figure. But the second you take a step back or step through the headline numbers and into the data, as we tend to do, it's a pretty hawkish report. We saw some pretty broad-based improvement with respect to unemployment rates of ethnic cohorts that had been previously left behind, namely African Americans and Hispanics. We saw a massive improvement in unemployment rates or in employment for folks who don't have a high school diploma or folks who just barely graduated high school. And so, in terms of the Fed's maximum inclusive employment mandate, this jobs report took it a major step forward, beyond the or underneath the headline figures. And I think that does put the Fed on a preset course to accelerating the taper on the 15th of this month and ultimately getting themselves into a place where they can hike interest rates in the first half of next year, likely at the June meeting. They'll probably get another rate hike at the September meeting. And the reality is that the fact that we're sort of on I think markets are pushing us towards a preset course for that, if only because the Fed has been so lagged with respect to the yield curve. It's been behind the curve for quite a while now. As a function of that, you kind of have a scenario in asset markets where, the Fed is going to be automatically tightening for tightening into a slowdown for an extended period of time. And that is a very different market environment than the one we just exited, or the one we're, either currently in or certainly in the process of exiting. So I think that does require.
When did that jobs report come out?
Yeah, jobs report. Oh, this morning at 8:30. That's the November jobs report. Yeah.
All right. And in terms of news, what do you think was a catalyst for last Thursday, Friday?
Oh, last Friday. Oh, I do believe Omicron was an issue, but I mean, it's all these dynamics. It's you don't necessarily need the catalyst, in my opinion. You need to understand how asset markets are pricing it in regime terms, and what happened, going into the beginning of last week, prior to last Friday's SmackDown, is that we sort of concluded the end of the mini reflation trade that we saw basically from mid-September through that time period, and we transitioned into something that looked more like stagflation or inflation, as we call it, at 42 macro. And so that was confirming the markets were pricing in a negative growth dynamic relative to the prior regime. Well, fast forward to this week, what's happening is now we're starting to price in a negative inflation dynamic as well. And historically, whenever you had both growth and inflation impulses are negative in the economy or the market's pricing that in, that's obviously something that catalyzes more volatility, more drawdowns in risk assets, and a lot more sort of investors running for cash.